Welcome back to CapitalCraft. Today, we're diving into an explainer that is absolutely going to shift how you look at borrowing. Most of us are taught from day one to fear debt, and hey, for good reason. But today we're unpacking a really fascinating economic divide, why the middle class is constantly buried by debt while the top 1% actively uses it to get richer. We're going to break down the mechanics of mortgages, business loans, investment leverages, and credit cards to see exactly how this whole playbook operates.
Okay, here's our roadmap for today's explainer. We'll start with the two faces of debt, move into the destructive traps, fire up the productive debt engine, peek at the wealthy borrowing playbook, and finally, navigate the hidden risks.
All right, part one, the two faces of debt, productive versus destructive. So check out this staggering macroeconomic reality from researchers at the University of Chicago. Leading up to the 2008 financial crisis, the top 1% of earners basically financed almost a third of the rising debt owed by the bottom 90%. Think about that for a second. The wealth piling up at the very top was essentially recycled right through the financial system and lent straight back to everyday consumers. The savings of the rich literally fueled the debt of the non-rich.
And this creates a massive, glaring divide. You've got everyday consumers using bad debt to buy liabilities. We're talking massive big screen TVs, depreciating cars, maybe vacations they probably shouldn't be taking right now. That kind of debt literally drains cash out of your pocket every single month. Good debt, on the flip side, is tied directly to cash-flowing assets, like real estate or acquiring a business. The income generated by that asset actually covers the debt payment, which means it's putting money back into your pocket.
Which brings us to Section 2, Destructive Traps, and how bad debt slowly drains you.
Look, the system aggressively pushes easy consumer debt. It's everywhere, right? High-interest credit cards, car loans, payday loans, and those buy now, pay later apps. And according to economists at the University of Chicago and Harvard, the bottom 90% are actively being convinced to borrow more and more. But here is the major macroeconomic trap. This unproductive debt drains future demand from the broader economy. Because households have to spend a massive chunk of their future income just servicing these loans, they've got way less money to spend on actual goods and services later on. That ultimately drags down economic growth and creates a really nasty high-debt liquidity trap.
Now, when you rely on personal consumer debt, you're severely limiting your future options. You're putting your own personal credit score on the line. And the interest you pay for that depreciating asset, yeah, it's almost never tax-deductible. Business loans, however, are a totally different beast. They build commercial credit, offer much higher lending limits, and crucially, this is the big one, the interest is often tax-deductible because it's being used to generate income. Personal debt just keeps you stuck in this highly taxed, low-leverage cycle.
Let's shift gears to Section 3, the productive engine. This is where we talk about leveraging debt to build wealth.
And this brings us to OPM, other people's money. This is the absolute fundamental tool that wealthy individuals use to scale their net worth. Without debt, you're capped by whatever cash happens to be sitting in your checking account. But by using good debt as OPM, investors can amplify their purchasing power, control way larger assets, and dramatically boost their return on investment.
Let's actually look at some real estate math here. Say Jane has $100,000 in cash. Now, she could play it safe, right? Just buy one property outright. Or she could use OPM, splitting her cash into 5 $20,000 down payments. The bank lends her the rest for each property. Boom! Now she controls 5 properties instead of 1. Because her rental income completely covers the bank's 5% interest and still leaves her with $300 a monthly cash flow per property, Jane has successfully multiplied her asset base using the bank's money.
But wait, it gets even better. By taking it a step further and using outside investors' money to put just 5% down on 20 properties, Jane can boost her annual return to an incredible 24%. Eventually, she can refinance those properties, pay back her initial investors, and just keep collecting cash flow with literally none of her own money left in the deal. That is what's known in real estate as an infinite return. That right there is the productive engine at work.
All right, on to Section 4, the wealthy borrowing playbook.
This is the famous buy, borrow, die framework. Sounds a bit morbid, I know, but it is incredibly effective. See, the wealthy rarely sell their highly appreciated assets because selling triggers massive capital gains taxes. Instead, they accumulate assets and then just borrow against them. They'll use securities-backed lines of credit against their stock portfolios or home equity lines of credit against the real estate. Because these loans are heavily collateralized, they secure incredibly low interest rates, often tied to the SOFR rate, to fund their affluent lifestyles entirely tax-free.
But hey, You don't actually have to be a billionaire to use the tax code to your advantage. If you own a home right now with a traditional mortgage, you're likely paying non-deductible interest. But by restructuring your lifestyle debt, we can actually change that. This strategy is known as the debt swap or the Smith maneuver. In many tax jurisdictions, interest is only tax-deductible if you borrow to earn income. So here's what you do. You sell off existing non-registered investments to pay down your home mortgage. Then, you immediately reborrow that exact same amount against your home equity to buy back into your income-producing portfolio. You haven't changed your total net worth or your debt level at all, but you've legally converted bad, non-deductible debt into good, tax-deductible debt.
The math on this is just wild. By simply restructuring a $200,000 mortgage using this debt swap strategy, assuming a 50% marginal tax rate, you can legally claw back nearly $27,000 in tax savings over 10 years. It's the exact same amount of debt, but a totally different tax outcome. Finally, Section 5, Navigating the Hidden Risks. We have to talk about the dangers here.
Because while these strategies are absolutely brilliant, we need to bring this back down to earth and impartially examine the very real risks of leveraging debt. Leverage is a double-edged sword, and if you aren't careful, it cuts deep. A fascinating study published in the Open Journal for Psychological Research breaks down the heavy psychological and financial tolls of carrying debt. They surveyed people to understand the perceived risks of borrowing, and what do they find? High interest and negative emotions absolutely lead the pack. People report feeling intense burdens, sleeplessness, and a deep sense of being trapped by those monthly installments. Debt doesn't just drain your wallet, it can seriously tax your mental health.
Across all demographics, the raw financial cost of high interest is the most universally felt pain point, sitting right there at 37%. Whether you're male or female, the compounding nature of high-interest consumer debt is without a doubt the primary engine of financial loss.
Furthermore, when you borrow to invest, like with that debt swap we just talked about, you have got to be aware of the structural risks. Just as leverage magnifies your gains, a market downturn will violently magnify your losses, potentially triggering margin calls. You also have to navigate some really strict tax compliance. Interest deductibility requires a flawless paper trail for the CRA or your local tax authority. And most importantly, you absolutely must have surplus cash flow from other sources to service your debt if interest rates spike or your investment income suddenly drops. If you don't, you're risking total financial ruin.
As we wrap up this explainer on CapitalCraft, I want to leave you with one final thought to audit your own financial life. Take a hard look at your statements this month and ask yourself, is your borrowing acting as a trap, locking you into paying for past consumption, or is it an engine carefully structured to build your future wealth? Understanding this divide is the very first step toward mastering your financial destiny. Thanks so much for joining me today, and I'll see you in the next explainer.